Welcome to the debate. Today, we are wrestling with a crucial tension, really defining the price trajectory of gold and silver right now. We have these foundational macroeconomic forces pulling one way, and then, immediate visceral market psychology and technical failures pulling the other.
It really is a critical juncture, isn't it? Our source material highlights this stark contrast between the certainty or near certainty of looming global policy shifts and then the uncertainty created by just extreme daily volatility.
Exactly. So the central question we really need to address is this. Given these opposing forces, which set of factors is likely to, define the near-term price direction for precious metals? My position is, it's firmly rooted in the fundamentals. I believe the sustained global trend toward monetary policy easing, specifically that highly anticipated rate cut from the Federal Reserve, coupled with persistent U.S. geopolitical uncertainty, provides the dominant and ultimately the defining bullish argument. The structural environment, I think, strongly favors safe haven assets.
Well, I come at it from a different angle. While I absolutely acknowledge the power of those fundamental macro drivers you mentioned, the evidence we're seeing around market behavior and technical resistance suggests that downside momentum is actually more likely to prevail in the near term. Extreme volatility has frankly scared critical speculative capital out of the futures market, and key technical ceilings, particularly that $50 silver threshold, indicate that a near-term downtrend or maybe just prolonged consolidation is more probable than a sustained breakout.
Okay, let's lay out the case for the upside then. The environment, as I see it, strongly favors safe haven metals, despite all this recent short-term market noise. We just got the CPI report, right? And this report confirmed that inflationary pressure is sufficiently contained, effectively removing the final obstacle for the Federal Reserve to implement that widely expected quarter-point interest rate cut next week.
That is a significant point, and yes, it dictates the immediate future for the dollar. But I would frame the consequence differently. While the prospect of lower nominal rates is theoretically positive for gold, sure, the psychological shift and the technical indicators presented in the material suggest that the immediate downside momentum holds more sway. The market isn't really acting yet on the promise of the future cut, it's reacting to fear today.
But the shift goes far beyond just next week's action. This is really about the long-term cost of money. The market is already pricing in, up to 2 additional cuts subsequently? This is signaling to long-term holders that the trajectory of real rates, that is, the rate of return after inflation, is heading firmly lower. And that fundamentally alters the equation, right? It drastically reduces the opportunity cost of holding non-yielding metals like gold and silver. This is structural support, not just fleeting sentiment.
Okay, you focus heavily on the U.S., but maybe consider the broader macro context too. Global monetary easing is already underway, and it is acting as a powerful positive factor, I grant you that. We've seen policy relaxation in China due to weaker economic data, and key central banks in Canada, the UK, and Australia have already enacted rate cuts. When global interest rates decline in concert like this, the structural support for precious metals is immense, theoretically.
Right. And furthermore, we absolutely must address the ongoing U.S. government shutdown, now dragging into its 4th week with no real end in sight.
Okay, so how does the shutdown factor in your view? How is that bullish now?
Well, the shutdown is critical precisely because of what it removes from the market: vital economic data. It freezes the release of essential metrics, things like job numbers, manufacturing indices, specific inflation gauges. Without that vital high-frequency input, institutional traders are, they're effectively flying blind. This state of persistent uncertainty creates a premium on true safe haven stores like gold. Until clarity returns, the uncertainty itself becomes the fundamental bullish driver.
I'm sorry, but I just don't quite buy that the theoretical sort of future bullishness of a data-starved market outweighs the concrete, contemporaneous market behavior we're seeing right now. The evidence points to improved risk tolerance across the market right now, which is directly bearish for gold and silver. U.S. stock indices, for instance, have risen strongly and hit record levels today, Friday. That's capital seeking risk-on assets, not safe havens. If institutions were truly paralyzed by uncertainty, wouldn't they be rotating out of equities, not pushing them to new highs?
That is a compelling counterargument, I'll admit, though I would push back on whether that equity strength is sustainable or perhaps merely a rally fueled by, maybe irrational optimism, a kind of dead cat bounce anticipating an imminent resolution to the political standoff. The underlying fundamentals, the necessity of lower rates, they still remain. I still believe the definitive Fed rate cut next week, confirmed by that modest CPI report, sets a clear, long-term bullish trend that temporary market euphoria cannot override. The reduction in global interest rates fundamentally alters the financial landscape for these non-yielding assets.
I accept the rate cut is positive, yes, but I challenge its immediate impact on price action and, crucially, market structure. We're seeing extreme daily price volatility. The source material suggests that both bulls and bears were so, quote, frightened by the erratic swings last week that they were actively leaving the market. This volatility has just made the market exceedingly risky for standard contracts.
I'm not entirely convinced by that line of reasoning, because I think you might be confusing noise for psychology. Isn't volatility sometimes just traders adjusting rapidly to, high-frequency trading inputs? Volatility can be fleeting. Lower rates are structural.
Wait a minute. When we talk about market psychology here, we aren't just discussing day traders feeling a bit nervous. We're talking about a measurable shift in liquidity and commitment. As evidence of this deep fear, look at the disproportionate increase in the use of micro and mini gold futures, specifically those smaller contracts.
Right. You're referring to the contracts that are, 1/10 the size of the standard contract? You said this signals weakness. How exactly does this shift to smaller trading vehicles damage the bullish argument?
Because it signals defensive trading behavior, not conviction, and it has crucial structural implications. Traders are accessing these smaller contracts precisely because standard trading is now considered, as the material puts it, very risky. They require less capital commitment, and the financial impact from price swings is smaller, sure, but more importantly, this shift fragments liquidity. When institutional players move their focus, even partially, to smaller contracts, it draws liquidity away from the standard futures contract, which is where major price breakouts need to be validated. So this flight of speculators, due to fear, coupled with this shift to defensive, smaller contracts, suggests that the market lacks the long-term conviction needed for a fundamental breakout. This reduced speculative participation makes the market thin, highly susceptible to downside pressure, and generally points toward a sluggish continuation of the downtrend rather than the sharp reversal you predict.
Okay. Let's transition then to the technical signal that I agree is incredibly important right now. Perhaps the single most important factor determining the short-term direction: silver's price action.
Exactly. And I am just not convinced that the current economic structure, even with easing, can override history at that critical $50 threshold for silver.
Can you elaborate on what defines $50 as such a critical technical ceiling, beyond just being a big round number?
Well, it has a 50-year price history as a major psychological ceiling and, importantly, a supply trigger. The past two major occurrences of silver hitting or even just nearing $50 resulted in only brief periods above that level before a sharp, sustained collapse. This isn't just psychological, it's technical, tied to historical supply surges and, frankly, speculative memory. Traders remember the pain of those collapses. The current difficulty in rising above $50 again suggests strongly that history may repeat, signaling a continuation of the historical boom-bust cycle. The market simply lacks the structural conviction right now to enter a new price paradigm above that level.
That's a compelling argument based on historical correlation, certainly. But have you considered whether the current environment makes that historical precedent less relevant? I mean, the previous boom-bust cycles occurred under very different interest rate and geopolitical structures. I would argue that we are seeing unprecedented global monetary coordination, multiple major nations easing policy simultaneously. This feels like a fundamentally different landscape than, say, 1980 or 2011.
But if the market genuinely believed the fundamentals you cite, wouldn't that resistance have been broken already? The inability to hold that line, despite global easing, despite the shutdown, suggests that the fear inherent in the volatility, and let's be honest, the lure of competing assets like stocks, is overpowering the macro case right now.
But isn't this resistance potentially just temporary until a critical mass of conviction is built? The material itself suggests that if silver does manage to stabilize and hold above $50 for, say, 2 weeks, the market might genuinely start pricing in new, higher long-term ranges. That stability would effectively invalidate the historical cycle argument, which is based on past conditions. Given that the bullish factors, the U.S. shutdown uncertainty and the global easing, are still very much in play and even compounding, a breakout is more than possible. I'd say it's fundamentally warranted.
That's a monumental ask, though, isn't it? Given the current environment where, as we discussed, liquidity is fragmented and speculators are fleeing, stability requires sustained institutional buying, not these fragmented defensive plays and micro contracts.
Okay, that brings us back to the major contradiction we observed earlier. If the U.S. government shutdown is creating this extreme uncertainty, which, should be the most fundamentally bullish factor for safe haven metals, why on earth are U.S. stock indices hitting record highs? These two facts seem, mutually exclusive on the surface.
Yeah, it's a puzzle.
It seems to me that perhaps the market is mispricing the duration or maybe the severity of the shutdown's ultimate impact. Institutional capital might be operating under the assumption that a political resolution is just around the corner. Once that uncertainty fully registers as prolonged dysfunction, meaning the fundamentals of fear actually solidify, then perhaps the metals will suddenly look like the mispriced opportunity.
I see why you think the shutdown presents a future opportunity, but the market is telling us what matters now. We have to acknowledge that the strength in the stock market, a concrete indicator of high risk tolerance, is a contemporaneous market indicator that overrides the theoretical bullishness of the shutdown for the time being. Traders are simply prioritizing growth and risk-on plays over caution right now. And we also have to factor in the U.S. dollar index. It has maintained a clear uptrend since mid-September. A rising dollar is almost always a general bearish element for precious metals.
Right, but isn't the USD strength itself potentially temporary, driven primarily by safe haven flows due to the government shutdown uncertainty? I mean, if the dollar and gold are both benefiting from the same fear, that paralysis in Washington, then don't the metals still hold an advantage once the dollar's policy-driven rally eventually dissipates?
Well, the market is actively choosing risk-on assets and the USD over safe haven metals right now. That choice confirms that bearish factors stemming from strong competing assets and general market sentiment currently hold sway over the theoretical support provided by Washington's inertia. If the risk premium from the shutdown was being priced effectively into metals, we wouldn't see stocks soaring alongside the rising dollar. The market is choosing a path of optimism, for better or worse, and that starves the metals of necessary capital inflows.
Okay, look, I remain focused on the long game and the structural necessity of lower rates. The core macroeconomic drivers, the global interest rate cuts, the subsequent reduction in real yield opportunity costs, and that persistent U.S. uncertainty, they provide a powerful and I think unavoidable fundamental foundation for gold and silver. The long-term perspective suggests upside is fundamentally warranted, provided the market can absorb this temporary psychological fear and the short-term volatility induced by liquidity fragmentation. The fundamentals will eventually assert themselves against fear.
And while those fundamentals are certainly intriguing, the immediate market structure is defined by fear and technical failure. We have extreme volatility, the measurable flight of institutional speculators, strong competing asset performance in equities, and silver's sustained inability to break and hold that critical $50 barrier. This current market structure points much more towards an imminent continuation of historical downtrends, regardless of the promise of a future Fed cut. The market moves on conviction, and right now, conviction is sorely absent.
So we are left with a fundamental standoff, it seems. The certainty of macro forces versus the immediate painful reality of market behavior and technical ceilings.
Indeed. And the resolution of this specific tension will likely depend entirely on whether silver can somehow manage to stabilize above $50 in the coming week or two. That stabilization, or lack thereof, will dictate whether the market enters a new paradigm defined by coordinated global easing or whether it resumes the historical, often painful boom and bust cycle dictated by those technical ceilings and speculative flight. There's certainly more to explore in the material as this situation develops.